Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. The market is sending mixed signals. Global stocks are outperforming while U.S. small caps struggle. And the Fed's rate cut expectations are fading as inflation remains sticky. Now, corporate margins are improving, boosting earnings, but consumer spending is becoming more cautious, especially in discretionary areas like restaurants. These trends highlight the shifting economic landscape. Now, let's take a deeper look at the data, see what else we could learn. The market is sending mixed signals. While global stock markets are marginally higher, U.S. stocks struggled in February, while international markets posted gains, signaling a potential shift in investor preference. Now, international stocks are benefiting from lower valuations, stronger economic resilience in Europe, and key growth areas in AI and tech in Asia. Now, for the year, markets are higher, except for smaller companies, where there's concern over interest rates. Now, bonds posted modest gains, reflecting a stable rate environment, while commodities tell a more nuanced story, with copper's surge hinting at rising global demand, while oil and Bitcoin's decline suggest cooling risk appetites. Now, this rotation highlights shifting investor priorities in a complex market. A key driver of the S&P 500 moving higher this year is the estimate for rising margins. S&P 500 EBITDA margins have been trending higher, signaling improved productivity and efficiency. Now, margins have rebounded, and now they're holding around that 21% level, a sign that companies are managing costs well and staying profitable. And this resilience supports continued market strength. Now, we may be seeing the early signs of a shift. International stocks, especially developed markets, have outperformed the S&P 500 and NASDAQ so far this year by 6 to 7 percentage points, and this started around the inauguration. While tariffs and trade tensions could be a factor, this trend also reflects expectations of rising growth rates and lower valuations abroad. So the key question is, are we witnessing a changing of the guard in market leadership? Now, since mid-2024, real-time data from the Dallas Fed has shown a steady rise in economic activity, and the index remains in positive territory, signaling sustained growth here in the U.S. Now, this reinforces that despite ongoing uncertainties and news headlines, the economy continues to demonstrate resilience. Real-time debit card data from Bloomberg shows that consumers continue to spend, reinforcing economic resilience. Now, while spending has moderated from several seasonal peaks, overall activity remains steady, with strength in key categories like food, retail, and gas, signaling continued consumer confidence. And that same real-time debit card data shows a concerning trend, though, in restaurant spending, which has been declining. Both full-service and limited-service restaurants are seeing weaker demand, which could signal consumer caution. And if this slowdown continues, it may indicate broader pressure on discretionary spending across the economy. Now, the average age of U.S. passenger cars has now reached 14 years, a record high, and we've seen this accelerate the last 2 years. This signals that consumers may be holding off on big-ticket purchases like new cars, likely due to higher prices and higher financing costs. And it's a potential positive for businesses that cater to things like auto repairs, auto parts, and maintenance services. Credit card delinquencies are rising, signaling financial stress for the stretched consumers that we noted in our annual outlook, even though levels remain below previous highs. Auto loan delinquencies are climbing, while mortgage and student loan delinquencies remain low. This divergence suggests that stretched consumers who skew lower income or earlier in their careers are more reliant on credit card debt, they are feeling the most pressure, while groups that we call the secure consumers remain in relatively good shape. Now, corporate capital spending plans remain strong across multiple surveys, signaling confidence despite higher rates. What's notable here is the alignment between small businesses, regional Fed surveys, and CEOs, all pointing to expansion. This suggests that businesses aren't just doing maintenance spending, they're actually positioning for growth. Now, trade policy uncertainty is spiking, which can slow decisions and thus economic growth. But history shows that businesses that adapt and invest during volatility gain a long-term edge. And this reinforces one of the key 2025 themes from our annual outlook, the need for agility as geopolitics reshape economies. To sum up everything from today, here are the key takeaways. The economy and markets are evolving, with global stocks leading and U.S. small caps lagging. Rate cut expectations are still soft while corporate margins are improving, and consumers are spending, though signs of caution are emerging. Navigating this environment requires staying agile as trends continue to shift. Now with that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.